All right, guys, what's going on? It's Monday evening, on the eve of madness. Have the elections tomorrow. Um, I'm not going to talk about current price action in this video. I'm not going to talk about the elections. I touched on all of that today in the SIGNUPS spaces, and my opinion hasn't changed. My positioning hasn't changed. So if you've been in the Telegram, you know both of those. If you're in the spaces today, maybe you know a little bit more detail. Again, answering just some specific questions from people that joined in. But the purpose of this video is to cover what I talked about the other day on October 31st, and that is this gap down being it being highly likely that this would be a successful bearish response and this would be a supply zone. So meaning as the market traded back to this level, we would be overwhelmed with supply, and it more than likely was going to see a bearish response rather than some kind of bullish reversal after this move. So this chart is obviously a TPO chart. I'm assuming that a lot of you guys at this point know what this is. This area of singles cuts off two areas where the market tried to establish value, but the area of singles specifically is an area where the market didn't really spend any time, didn't establish value. And even though this is determined by an area where there's no overlap in 30-minute candles, it doesn't mean that the market spent 30 minutes in this level, obviously, right? What this means is that in this particular move, the market moved through this level very rapidly in just a matter of minutes. But again, it's basically an air pocket. It's a gap, and there are some ways that we consider or approach this depending on context and depending on where we sit within the trend. And in this case, it was leaning more heavily to be bearish at that level than to be bullish. For those of you that followed along in the following day after this, my thesis for the day laid out, or the game plan for the day played out pretty much to a T, as far as upside targets being that VWAP and the beginning of those single prints being ultimately a supply zone, assuming that it would overwhelm buyers and we would see the market continue down to trade back to the lows. And all of this is in the Telegram. Again, the day worked out perfectly. Not every day works out perfectly, but I do want to go over this. I do think it's important to go over this setup. So to paint more of a picture of context leading up to this, market has been in a strong trend. So if we look at the 4-hour chart, if you look at the daily chart, marching back up to all-time highs quite impulsively. There's a lot of participation behind this move. Markets are getting aggressive into the election. A lot of confidence placed behind was largely the belief by CT that Trump is going to take the presidency. We've had some shuffling over the last couple of days with started by a pollster, but again, not going to touch on that. I think the pollster is only something that, or she maybe added a spark to what is already a tinderbox to set up what ultimately was this pullback. Again, market pretty crowded into a level, and the level is very cut and dry. So we have a market then moving up quite rapidly. We have no pullbacks of this sort to this point. So we're looking at the first time where the market is rejected and we have a gap down and we're left with these singles. And this is after the move up to all-time highs. So this is our all-time high move here. Is a good amount of excess at that high. We follow with a balanced day. So ultimately after that kind of move, you're looking for maybe 2-3 days of balance to form, and then to have some kind of break from balance to the upside again to retest that. But instead, we balanced out briefly in the session, trading within value, trading within where most of the volume came in, and then ended up seeing this cascade through prior days' lows. And I think you just got a lot of positioning that got aggressive and got involved towards the highs. And I'll point that out in a second as to how that is seen more obviously, and indicates rather that this was a supply zone based on looking at this chart in particular, open interest, and the positioning that was put on leading up to that, and how not a lot of it came off in this initial move down and then ultimately came off down here on the retest of that level. So you have a gap down like this, right? So the market doesn't spend any time here, doesn't really establish much value here. But this should be a simple video. The idea is, why is this a supply zone on the retest? And the retest is more likely in this case to be negative, right, for bulls and positive for bears, because This is the first big gap down and response that we've seen leading up to this point. And again, the market is pretty crowded into the highs. Positioning is up. Market is very optimistic, and we're a couple days away from a very significant presidential election. So you do have this as being the first sort of shot across the bow that we've seen in a couple weeks, in a couple days. We have not had a gap up to this point. So if we look at all the days leading up to this, market has never left behind this kind of structure. We never had a double distribution day down. And this is a very impulsive day down. It starts off balanced, impulsive move down, begins to balance out. But the moves like this that happen for multiple reasons, right? They happen because if you look at where the move really began to spill, more than likely we're hitting a cluster of stops. We're hitting areas where there are liquidations. And again, the market just doesn't spend much time here at all. The book kind of empties out. All of these orders are triggered. Again, a lot of the times you see these people tend to put their stops in the same area. And anytime you have a structure that has marginally higher lows, it's very easy for people to just trail stops up and for that area to be a cluster where you'll have this kind of gap through if you return back to that level. If anyone's been following me to this point knows when I sort of draw structures that I think are dangerous, and that is when you have something that has been very nicely moving upward with lows intact, each one successively higher than the next. No real basing out though, no real structure built, but just this kind of low time frame structure that has been uninterrupted all the way up to the last point. So it sets these sort of pockets to trigger into each other to create this type of liquidation move and this type of stop run. Now, interesting point is that if you use like TradingView native indicators, and if you use any TradingView native liquidation indicator, TradingView is not connected to level 2 data, right? TradingView doesn't actually have forget level 2, TradingView doesn't actually have the information for liquidations. TradingView makes an assumption that liquidations have occurred based on the market moving very rapidly, right? So very rapidly in a very short period of time. And a lot of times that is because there are stops that are ran. And then the assumption is also that that is on the back of liquidations taking place. So why is this a supply zone on the way back up when it's retested? Well, it's really simple. The level that's hit, right, is an area where there are stops that are placed and where people, again, might manually exit the trade if they're in front of the screen at the right time, just following it along and pulling themselves out. But we could safely assume that where there are areas that stops are placed, there are also people that placed positions towards the high and didn't necessarily place a stop. And this move has caught them by surprise. So if you look at moves like this on the way up, where open interest is very much up into the move, and you have a move against that, and you don't start to see a bunch of open interest come off, but you do see that the market is trading below that average, a lot of times you can correctly guess that whoever is behind that positioning, whether it's one person, whether it's a bunch of people, that they are there's a significant side that is underwater, right? If you're using like an anchored VWAP and we're trading below that VWAP, it's safe to say that bears are in a better position than bulls. And it's likely that that position is underwater and still kind of hanging on, and that if the market continues to move against it, that we'll start to see those liquidations come off, which could lead to a much nastier puke, which we ended up getting. But then on the return, even more likely is that for the people that have round tripped at that point, on the return to that level, they'll be more than happy to get out of position. And a lot of times, again, we're just making a very simple assumption that has, look at this over the course of, all the history of your charts, do a quick eye test, back test. When you have these single print moves down, and we are assuming that, okay, this was an area where the market moved through very rapidly, it's from stops being triggered, liquidations being hit, there's more than likely people that do have the same invalidation but didn't place anything to get them out of position. So when we trade back to that average price, when we trade closer to that positioning, you're going to start to see it act as supply again, because those people are more than happy to get out at break even. So a lot of the times these single print regions, especially the first one, have a very high likelihood of rejecting price if we're returning back up to it. And the same can be said if we are, if we have a structure like this after a breakout and we're retesting it from the high, off of the lows especially, and you have maybe shorts that are underwater who are more than happy to get out at break even, and you get that bounce at the level from the high. So if you look at open interest, it's much more obvious in this case. This is the entire structure across. There's a good amount of positioning built up. This is the initial spike below where that single print was created, and that is the corresponding OI that came off, which was around like 4,000 BTC. But then as we sort of trade back to this level, so as the market moves back up, all right, so retest that single print gap, which is right here. As that happens, then you see a ton of positioning come off. And this is, if you have it on a higher aggregation, it's tougher to see exactly where that positioning came off. But if we just draw from the retest right on to this point, you're looking at obviously a bigger spill down here as well. But the retest to that level is where we started to see a lot of positioning come off. So in this case, because of the, just after the fact, I wasn't even looking at this during it. It was just starting to fail either way. It almost looks like in this situation, it was one player that was more than willing to get out of this entry after, maybe adding to position a little late and rethinking that after this initial failure, but not having stopped themselves out after this move, right? So the market comes back to that level, and they're more than happy to get out around that entry point, average around that entry point, and we see that is overwhelming any kind of buying that comes in. And a lot of times this is, again, if you have a trend that's been intact for a while and you have that first reversal day like that, and the market does tend to get a little top heavy, especially at very significant levels, right? So when it looks like the market is going to break out, you get, in this case, it was, a little bit more obvious also because we had the premium come back. So if we just look at the premium, this was the first time since I think going back to June where perps were trading at a premium to the spot market. Yeah, let's go back. Yeah, going back to June. So good memory. So yeah, market getting very aggressive at an obvious area, and that's it. So I mean, simple stuff really. It's understanding how people trade basically, and this move is a lot of times because the market has moves at this velocity are because there are stops in certain areas and clustered in areas, and those involuntary orders are hit, and at that point we could also assume that because those were there, and this positioning was averaged out along a pretty obvious zone, that there's also going to be people that added into that had no method defined before for exit, and they're underwater, and upon return to that level they'd be more than happy to get out as close as possible. It doesn't really require too much complicated reasoning, because everyone who is listening to this has probably been in a position that was poorly managed or just poorly executed. You're getting excited for a breakout, you add a little early, market trades back against you, and you think, oh fuck, is this going to be the one, or should I, you know what, I'm just going to reconsider. I'll get out if the market gives me a good entry. Sure enough, the market trades back up to that level, you get that throwback, and then you get out, happy that you were able to get out with all your skin. So that played out perfectly. That was great. And a lot of times, single print levels, you don't have as much of a prevailing bias, on the return. You just look at this as, if I'm absent all of that surrounding, absent context, right? If we're just looking at this in isolation, which you wouldn't, I would be looking at, okay, this as the first level to either make or break. And you either have, again, if these are just equal weighted, you either have a situation where the market trades, accepts back into this gap, and then it's a pretty quick move to the other side. Market usually fills out gaps, or this is the cutoff point, and you get the rejection like you did. More often than not, just when you have these gaps either way, you'll see that the market will end up filling them out, right? Areas that are left behind, they'll often get revisited, filled out, And if you don't get this initial rejection, you know, there are some setups that you could take where it's all right, we're going to trade back to the POC, you know, depending on how much dip the market has and what other things you're seeing in the flow. Okay, so we reclaim this single print zone. It's probably going to be a throwback up to the all-time highs. But in any case, you know, you're going to be determining that based on a little bit more nuance rather than just saying, okay, if this, then that. But that's that, guys. Hopefully that is clear. If not, leave a comment on this video. I'll be more than happy to get back to it. And happy trading tomorrow. Happy trading this week. I don't think you'll have a winner within the next, you know, probably like 36 to 48 hours. You'll have an unofficial winner, meaning it's kind of obvious who won based. You're going to have a lot of people that are, you know, experts in this area. They're going to tell you who won, and probably going to be the case, but you'll have it fought, I'm sure. I'm sure, you know, if Trump loses, for example, I'm sure he does not go down without a very long, dragged out fight. All right, guys. Until next time.